Thank you all for coming. We're going to talk about how not to get burned by your NFT business. And let me start out by, first of all, introducing my panelists. And I'll start with Joshua Hale. And why don't you tell us a little bit about what you're doing, Joshua?
Hi all, I was just up here. I'm an attorney in the space. I represent everything from blockchain and NFT projects to real world asset projects. And I basically do outside general counsel for companies. I help them find the right structure. I help them design a product that will fit in the legal area that they are as far as jurisdiction, and help them hopefully not design products that are going to land them in hot water. Obviously the world's changing every day, but we try to do our best. Josh Hale.
And Garrett Brodeur.
Hi everyone, thanks for having me today. My name is Garrett Brodeur. I'm an associate tax attorney at Castellanets in New York. We specialize in tax litigation and white-collar criminal and civil defense, and also some tax and estate planning work. Before joining Castellanets, I clerked at the tax court for 2 years, and I'm excited to be here today to talk to you about taxes.
So let me tell you a story. I met some people last summer who were selling NFTs on a blockchain, and it was very well received, and people paid for it with the coin on that blockchain. And in the period of 3 months, they made $5 million worth of this coin. And very excited about the product. They didn't have a second product in mind, so they just, what they did with the 5 million, if you will, they kept it in coin of Cardano, and they distributed $500,000 to pay their bills and to pay each other. The remaining 4.5 million worth of these coins, they sat on them, and by the end of the year, the value of the coins had dropped significantly. So what they did, without realizing it, was when they didn't liquidate those coins when they received them, is they moved into an investment state. They were investing those coins, because everything in the world of taxes is done in dollars, not in tokens. And what happened was they sold $5 million with $500,000 of expense. They had taxes on $4.5 million. It was basically an LLC. Each individual, 4 members of the partnership, and so each one of them would owe a share of the taxes and the profits from the enterprise. So at the end of the year, they found out, oh, I got to pay taxes on this? And they called up a bunch of people. They called us up as well, and we reviewed the situation. And they were in a position where the value of their coins were now less than $1 million, and each one of them would have to have paid, they would have to have liquidated those and paid out of pocket to pay their tax bill. So here we have some guys with great ideas, great imagination. They offered a product that people wanted, and at the end of the year, they're in a position where they're looking at tax fraud because they're not in a position to file that tax return. That was not what they envisioned in the beginning. And so that's what we're going to explore, is a little bit about, if you're starting a project, how can I avoid not ending in an ugly position? And so that's why Josh here, as a general counsel, can talk about a broader set of issues you need to be thinking about. And Garrett's going to talk to us about how do you dig yourself out of a hole like that. So I think maybe we'll just turn it over. I think I'll turn it over to Garrett first, since I laid out the tax dilemma. Tell me about how you advise clients as they get into that situation. How do you help them dig their way out of these sorts of tough spots?
Yeah, Clinton, that's a really good question. Taxes are hard, and crypto taxes are even harder. So I think the wisest thing you could possibly do, and a little self-promotion, is to get a tax attorney involved. Hire counsel early and often while you're planning your work, and when you get a notice from the IRS about an audit. It's even more important. That's what my firm does. I think that's one of the key things that you can do, and I'll discuss maybe in a little bit after we get to this question and hear from Josh, some ways that you can actually participate in the way that the current rules around crypto taxes are being proposed and crafted by the IRS and Treasury. And that's more of a long-term approach to how you can keep from getting burned by crypto taxes. But as far as how to dig yourself out of a hole, the key is to avoid getting into the hole in the first place by getting tax counsel involved early and often so that they can review what you're doing and point out the potential pitfalls. And then, God forbid, if something happens and you were to get into a hole, get tax counsel. They can help you through the process of navigating a notice from the IRS or an audit.
Very good. Thank you, Garrett. So Joshua, you like to get in very early on with a client. As a general counsel, how do you touch on all these topics, along with the other complexities that they legally need to understand?
Yeah, so one of the big issues, and even what Garrett has said here is, talk to somebody early and often. However, in some of these projects, you have a situation where it's somebody who never dreamed they would make $5 million. They never had any inclination that that would happen. And so, like, a lot of my work is figuring out the proper structures. So a structure is taxed rather than like Garrett or Clinton. And if you do that properly, you can save a lot. The problem is, to do it properly, it requires money. And some of these projects, when they're starting, have none. They're a wing and a prayer, and they have no inclination that they'll ever have what they're hoping to have. So something is better than nothing. Some of you heard me a couple minutes ago talking about DAOs. You should at the very least talk to somebody and say, hey, we're doing this thing. There's a possibility I could be a millionaire tomorrow. Talk to somebody, spend a little bit of money, if nothing else, because some protection is better than nothing. I do work on projects as outside general counsel, and I very much prefer when a client starts with me from the beginning, because I can craft very elaborate plans to give them as much protection as possible, both locally and internationally. And as many attorneys will tell you, there are different jurisdictions in different places, like they were talking about Puerto Rico earlier, that can do some really, really neat things for you. But ultimately, the only way you get the benefit of all these cool things for tax avoidance or mitigating tax is to talk to somebody who understands that in the first place. Because my guess is if you're starting a project and you don't have the wherewithal to pay an attorney today, you may also not have the education as far as the tax side goes to know what happens if I get a $5 million tax bill. So talk to somebody, even if it's momentarily.
Very good. Did you have any reflections on that, Garrett?
Yeah, I think Josh mentioned tax avoidance, and I always like to think of it as tax minimization. No one is required to pay more tax. No one is required to pay more tax than they owe based on their activities. So it's perfectly, that's the only thought that I really had to add. It's perfectly acceptable to try to work and minimize your tax liabilities based on your activities. It's not illegal to pay less tax when you're not liable for that tax.
Yes, I think when I've spoken to clients that these are very good comments, but they'll think, well, I'll think about tax after I've got my product launched and the sales have come in. And that's probably your first mistake right there. You need to you need to have a plan up front as you run a business. Because I think oftentimes an NFT creator is at heart an inventor and an artist. And the business side of a business is not something that's coming naturally to them. And I think, Josh, that's kind of what you're doing, is helping creators find a path through the legal maze that they need to be thinking about, depending on which jurisdiction they're operating in.
Oh, absolutely. And you also have the idea of, when's the best time to plant a tree? Yesterday. And it's the same thing in business and in crypto. When's the best time to plan for my business? If you're already doing something, the best time to plan was yesterday. So, yeah, talk, open your mouths, find a confidant, find a mentor, Everybody, there's a lot of attorneys in this industry. There's a lot of attorneys on these panels. At the very least, talk to somebody so you have some understanding of what is coming down the pipeline to you. Because if not, it's going to come as a surprise, and that's not a real happy day.
One other idea that I wanted to float, and Clinton, on your earlier panel, for those of you who've stuck around for the past hour or so, they talked about Notice 2023-27, and the IRS is proposing rules on how it hopes to tax NFTs in the future. And that's by classifying certain of them as collectibles under the tax code, which would subject them to higher long-term capital gains tax rates, 28% as opposed to 15 to 20%. And it would only apply to certain NFTs, those for which the underlying asset or right is a collectible as defined in the tax code, like an antique rug, a quote-unquote work of art, alcohol, or gold coins or something like that, stamps, antiques, tangible property. The IRS is wanting to extend that definition to digital art, NFTs. And one way that you can prevent from being quote-unquote burned by these taxes, the higher tax rate in the future, is to actually participate in the process that the IRS is going through to craft these rules. There's a notice and comment period open right now through June, and the IRS is inviting industry to comment on whether digital art should qualify as a collectible under the tax code, given that the tax code currently only applies to tangible property, not intangibles. So there's a real opportunity here for the industry, for you all to comment, provide your insight on the ground to the IRS. Treasury's wanting to hear our voices on whether the digital assets should be considered collectibles and subject to higher tax rates. And I really applaud the IRS for this approach, because other regulators in other parts of this industry haven't invited that such engagement by the industry. So this is an opportunity. And when I read the title of the panel, How to Avoid Getting Burned by NFT Taxes, I thought, that's kind of an opportunity right there to engage and have a say in the way that the rules are applied to NFTs in the first place. So the notice and comment period is open until June, and if you just read Notice 2023-27, there's an actual email address where you can submit your comments to. It's a really easy process, and I think that's an interesting way that you can avoid getting burned by NFT taxes.
Maybe they'll listen. They have to ask, but it is a complicated question, the NFT tax rule. When is something a collectible? What is a collectible? What is it? When does it rise from mere sentimental value to collectible value, and what does that entail? So there's a lot of questions that have to be teased out. And I think that raises an interesting question, Josh, I would like you to reflect on. As people operate in different jurisdictions, you're dealing with different tax laws, different laws relative to whether it's VAT taxes or other taxes, or also licensing, being able to license and sell things in different countries. How do you give perspective to people in tackling those problems?
So interestingly, in a lot of the world, where the United States has very little legislative intent that has happened so far in crypto. And I use the term legislative rather than regulative, because we're still talking about the legislature that needs to do something, not just the three-lettered agencies. But when you're going internationally, a lot of the countries around the world look at this very differently. The United Kingdom, for example, has this as crypto is a commodity. The Dutch have basically determined that crypto is not ruled as anything under the law. So right now, it's the Wild West in Holland. So you have to start looking at the jurisdictions. You have to start looking at what you're doing, and then you have to start looking at, am I actually with this business registered in Timbuktu? Am I going to have an issue in these other countries where I have buyers? And the answer is, like all attorney answers, maybe. And while everybody hates that answer, I can give you the other end of that answer, which I gave earlier as well, is if you don't think about this stuff, am I screwed? And the answer is probably.
Very good. Let me throw it out to you. Does anyone have any questions about NFT taxes and starting an NFT project and the tax obligations? Yes, sir.
So
Are you talking about as you're holding it?
Yeah, well, if I just hold it.
There's no taxes on holding things. You're only taxed when you, we say sell or exchange it. So so whenever I get rid of it, that's when I experience a gain. Because with property, income occurs when you sell it. All right, that's if you hopefully you sold it for more than you bought it for, that's the gain. And until you sell it, you haven't experienced income.
Oh, nice.
So yeah.
If I have stake and yield, like as coupons.
The stake in and of itself is fine. The yield has money or assets coming back to you, and yeah, you should be paying attention to that.
Yeah, so it's like more like dividends or just like income from like some assets.
It is an income. It's literally money coming in, income.
It's like interest income.
Since you didn't own it before and it's given to you, it's treated as income at the fair market value in US dollars on the day you receive it.
Okay.
Right, so it's not the value at the end of the year when you pay your taxes, it's the day you received it. That price may change later on as you receive other staking rewards, but that would be how you do taxes on staking. Now that's not capital gains, that's just treated as other income, and there's a line on the tax return that says other income, and that's where that gets reported.
Oh, thank you for explanation. Bullish on NFT Python.
This might go without saying, but Clinton's comments just now raised another idea. In my practice, what we often see, not digital asset related, is just very bad record keeping. And in other aspects of tax, it's really difficult to advise a client on the back end when they're in an audit, when their records are bad. In digital asset space and NFTs, when you receive staking rewards, it's critical that you keep records of your transactions. That way, if an audit does happen later on, it's much easier to go and untangle things and find wallet addresses and calculate the value of assets, aggregate things whenever there's good record keeping. So how to prevent getting burned from NFT taxes? Keep adequate records, organized records.
Interestingly, right now you have a new thing that's happening, which is NFT loans, based off of I have this NFT that's worth $10,000. I'm going to take a loan out on $6,000 with that as collateral, and while that money comes to you, in and of itself, that is not considered income, generally speaking, unless I'm
No, it's not
completely
income.
mistaken. However, what happens if the loan, because the amount of money it's worth changes in value, and that asset gets seized as the collateral? And I know the answer, but I'm very curious what you guys would say as far as what income came in.
That happens. So in that case, you put the asset that you put up there as a collateral. When the price goes down for it, it's basically you've agreed to a forced sale.
Yep.
They've sold it, and that's basically the sale price right there on that asset. You may have experienced gain or loss at that price, that's just how that's treated. We have a couple questions out here, right here in the blue, and then I'll come over to the black next.
So when you have the yield, it's considered income, so it would be the US, well, in this country, it would be US dollar at the time of receiving it. That's how it counts. So if you hold on to it, then it's an investment.
Right.
So now you're getting into that. And if it goes down in value, obviously, and you still owe it at that value, you're kind of screwed, right?
Right. So let's say a coin is given to you as yield, all right, it's a form of interest, if you will. So let's say it's at $1. Now you hold on to that coin. Now that coin has become an investment. The cost basis is the price you got it at, $1, and then it goes up in value. Let's say when it hits $3, you sell it. Then you experience a capital gain on that $2 gain that you experienced there.
That's why.
Good thing, but if it goes down, it's a liability.
Well, if it goes down, then of course you pay taxes on the $1 price that you got it at. It now goes down to 75 cents. Of course, we're talking multiples here, but yeah. But then at that point in time, if you disposed of it, you would be experiencing a 25-cent per token loss on that.
That's why the rebasing that you saw not too long ago was happening, was to avoid that issue of income coming in. They were basically changing the value of the token by not doing like staking contracts where you're getting stuff. They were changing the value of the actual token that you held. And that changed that analysis from a legal point of view. And that's why that came about. It's really cool stuff, but ultimately it came about because of the tax question.
I think we had another question over here.
Okay, so this is maybe a little complicated. I'm not sure if you guys can answer this or not, but okay, so I'm self-employed, and I know other people that are also self-employed, and that also do a lot of trading as NFTs. Now, I don't think that this applies, but I wanted some clarification. I know that there's a separate tax, like you can mark yourself as a trader if you trade securities, like often, like a lot of securities, and then you can mark them as like mark to market. Does that apply at all in the cryptocurrency space if you are like a very active trader, where you can actually set your designation as I'm self-employed as a trader, and then you can deduct expenses from, working as a trader? You know what I'm saying?
Yep.
Does that apply to cryptocurrency or no, because that's only for securities?
It can apply to cryptocurrencies.
Okay.
To qualify for active trader status, Section 475 of the tax code, there are some difficult rules for a lot of people to maintain. Your average holding period for the assets that you're trading cannot exceed 30 days. All right, so you may, as a trader, you have maybe a pool of assets that are your HODL assets.
Yeah.
You need to keep those isolated, separate wallets, separate accounts, so that you can say that's my investment money, that's not my active trading inventory. All right, now, secondly, you need to be actively trading, and there's a complicated formula, but you need to be actively trading 4 days a week, consistently throughout the entire year. Okay? And so a lot of people are active traders, but then they say, wow, the market's kind of soft, I'm just going to hang out for a month or two. We just wave goodbye to your active trader status. Another thing you have to do with active trader status is you have to send in a letter to the IRS. It's a very short letter saying you're going to be an active trader, and you have to do that the year before you want to be active trader. All right, or actually there's a certain date into the beginning of the year. So you have 45 days into the year to file that. So all of that, and what's the benefit of active trader status, is that rather than being taxed when I sell it, I'm taxed basically at the end of the year, what we call mark to market. So this is very much how companies handle inventory, and that's the whole purpose of trader status. It's for dealer firms and stuff that they're moving all the time, so they have assets they're holding. How do we tax that? So you're looking at what's the value of my assets January 1st? How much did I buy that year? How much did they sell that year? What's the value at the end of the year? And then I pay tax on that. All that's going to be short term, so we're not talking any long-term taxes when you're an active trader. By doing the mark to market, I'm paying basically just the tax on the net gain over the year over my assets. Now, if it's an up year, your taxes are going to be the same as though you were not an active trader. The excitement about an active trader status is when the market's down, because if you're just talking regular capital gains, you're limited to a $3,000 capital loss write-off. But if you're an active trader status, you can write your entire loss off that year against all your income. So it's all deducted, so there's no loss limitation. You could drive your taxes down to zero. That's exciting, but you need to, it's not something you can casually jump into. It's difficult to initially qualify for, and you got to sustain it. So it has to be disciplined. But it's actually, I wish they opened it up more, because I think doing what we're doing now with gain calculation is just burdensome, and a mark-to-market approach would be so much nicer. But it deprives you of long-term holding status on those assets. So you can't be active trading and say, "Whoa, I like these, I'll move them long-term," because those get counted into your holding period limit of 30 days. So a lot of rules, a lot of subtleties on it. You got to be really intentional.
Okay, cool. Thank you so much.
You're welcome. Any other?
Best explanation ever.
They aren't flagging me off, so I assume we have room for more questions. Yes.
I had a question about how are airdrops taxed? Like a lot of projects, they airdrop NFTs and they have some value.
The IRS
Yeah.
came out with a revenue ruling that said airdrops that are coming with a hard fork would be taxed at the time they're received. The IRS has not specifically made a statement on airdrops in general, but their principle, drawn from other things they've stated, is that an airdrop would be taxed at the fair market value in US dollars on the day you receive it. But as we all know, a lot of these airdrops are, they're shit coins, so I don't, I'm not gonna waste my time calculating that, and that's acceptable.
One other addition is it's taxable on the date you receive it, which means dominion and control over it. If it's locked up or you're not able to like withdraw it or actually dispose of it yourself, you haven't received it. So that's not the time that you'll calculate the fair market value for purposes of taking it into income.
Okay.
That's also in the revenue ruling that Clinton mentioned.
Yes, that's a very important topic, constructive receipt. Taxes are wonderfully interesting, and as my opinion, taxes are very sexy, and because everybody wants to think about it, all right?
Gross, Clinton. Gross.
We're not talking about your sex life. So, but I'm glad for your time. How can they reach you,
Yeah,
Joshua?
you guys can reach me. Josh, anywhere you can find me. If that's hard, hashtag green glasses on Twitter. I'm pretty easy to find.
Garrett?
You can reach me on Twitter, GLBrodeur8, or you can email me. I'll be right at the back of the room afterwards. I've got business cards. You can find me on LinkedIn, Instagram. Yeah.
Very good. Thank you very much for all your time.